Broadcasting live from the Business RadioX studios in Phoenix, Arizona, it's time for Phoenix Business Radio, spotlighting the city's best businesses and the people who lead them.
Hello, Arizona. Welcome to the Legitimate Podcast with your hosts, Mike and Rochelle Poulton, where we share our legitimate perspectives on how to get ahead and stay ahead in law, business, and life. I'm Mike Poulton. I'm the managing partner of Poulton & Royan. We're a litigation firm and business law firm here in Central Phoenix. I also do real estate investment and a few other things. And this is my lovely wife, Rochelle. She's the managing partner of X Firm and a few other businesses, and I'll let her fill you in on what she does.
I'm an attorney too. We help people with financial transaction planning. So we deal with all sorts of fun stuff related to businesses and people's personal finances. And especially right now when things are a little weird, sometimes it's just helpful to ask an attorney. So that's what we're doing. But today's topic, we're talking about financial goal planning, but a little bit on that later. So first up, we've got the rackets. And today's racket is about student loan relief. Student loans are still in forbearance right now. Administrative forbearance for federal student loans under the CARES Act lasts through December 31st of 2020. And for a lot of people, they haven't been paying student loan payments. Maybe you haven't noticed that you haven't been paying student loan payments. But for some people, they're still looking for long-term relief options from student loans, which means that maybe you're looking at trying to apply for a borrower defense application or a school closure application. And that's why it's on the rackets. Processing these types of relief applications are extremely time-consuming and difficult, and the odds are they're going to be denied. The Department of Education got sued this year over failing to process the borrower defense applications in a timely manner. And so now there's this big 18-month push to get them all processed. And the easiest way to process is to deny. So some people are getting a credit applied to their account for $100 up to a couple $1,000s for the delay in processing their applications, but still they're not getting the relief that they were seeking. And the only way to kind of overcome that challenge is through appealing it. But the unfortunate reality is when you're dealing with student loan borrower defense application relief, is that you have to state a claim that would have been actionable in your state. So what does that mean? Well, it's legal jargon basically for like, if you could have sued the school and gotten your student loan forgiven, then that's the basis that you need to use in your borrower defense application. So in Arizona, you're pretty limited to stuff like breach of contract, consumer fraud, maybe some bad faith claims. And the funny thing is a lot of schools where people would be seeking relief have already been sued by the Attorney General's office. So our wonderful Attorney General has already sued a school over misrepresenting marketing claims, maybe consumer fraud, something like that. And that provided relief on the private student loan side, but that does not translate to the federal student loan side. So if you're thinking you've got a slam dunk case on the federal student loan side and you're submitting a borrower defense application thinking that, oh, well, they sued the school, so I should be entitled to federal student loan relief, don't hold your breath. It is a nightmare situation developing. So why is it on the rackets? Because I want you to actually put it on your radar. Contact your local legislature about this. This is something that needs to be addressed. Student loan relief is a problem. We rack up, $3,000 a second on student loan debt in the United States right now. It's quite significant. And for some of those people, especially if you went to a school like Arizona Summit Law School, there is no relief. It's pretty terrifying to have a $300,000 student loan debt and a non-marketable law degree. So just keep that in mind that this issue affects a lot of people. And if you're one of those people that has some student loans and are seeking relief, just make sure you're talking to a professional who deals with it on an ongoing basis to walk you through the process and make sure that you have the best chance of success at getting the relief that you need. But right now, it's ugly. So that is our rackets moment.
And now for today's LBL moment, law, business, and life. So law today, Rochelle's going to tell us a little bit about the FDCPA and what collectors under certain circumstances can and can't do to annoy you if you owe them money. And I'm going to talk to you about commingling your business and personal finances if you're a business owner or sole proprietor. And then we're going to talk a little bit about traveling in the time of coronavirus. So, Rochelle, what's going on with the FDCPA? What are you going to tell people about today?
So the FDCPA is the Fair Debt Collection Practices Act, and I've been getting a lot of calls recently about what can debt collectors do right now. And so I just want to talk about who the FDCPA protects. The Fair Debt Collection Practices Act protects people. So it does not protect you from the original creditor, and it does not protect businesses. So if you are a business owner and you're getting hounded on credit card debt or lease agreement non-payment or whatever the issue may be, the FDCPA is not going to protect you because the FDCPA only protects people, not businesses.
And I think it's fair to say it protects consumers in consumer transactions, right?
Yes.
So if you're doing some kind of sole proprietor business activity, you're not protected by the FDCPA for debts that you incur as a business owner. If you're doing something for a commercial purpose, even if you're doing it in your own name individually, the FDCPA does not protect you from collection activity for that.
No. And when it's the original creditor, the FDCPA obligations do not attach. So a lot of times you'll see someone, they're like, oh, well, you can't call me 50,000 times in a day because of the FDCPA. And it's like, well, they're still the original creditor. So it's just bad form, but it's not illegal. Sorry.
Yeah, people you owe money to are stressed right now, too. Landlords are having a very hard time. Businesses that extend credit to customers are having a very hard time. So keep in mind, if you're having a hard time paying somebody, they're having a hard time getting paid, too. Everyone's facing the same business stresses, and that annoyance and perhaps even desperation that you feel is also coming from the other end of that phone. So it's a tough time, and it's going to be a little contentious and difficult for a while.
Let cool heads prevail.
Yes, indeed. So banking and commingling. Down the road, if you have collection issues going on and you're a sole proprietor or small business owner, you may end up in a situation where you have to defend the separation between your business and your personal activities. Now, if you are a sole proprietor, of course, this doesn't matter because there is no separation between your business and your personal activities. You are your business, and vice versa. That's why you probably shouldn't be a sole proprietor. We've talked about this before. Any attorney you ever talk to will tell you if you're doing any kind of business activity, you really ought to form an LLC or a corporation or other limited liability business entity to deal with that. In Arizona, the simplest approach and almost always the most favorable approach is to form an LLC and handle that appropriately. So what does it mean to handle it appropriately? Well, there's a bunch of stuff you got to do. It's not terribly difficult, but it does matter that you know what's on the list and you follow the rules. And one of those rules is that you maintain clear separation between your business activities and your personal activities. When I say activities, I mean financial activities, because that's kind of all that really matters when it comes to business. So if you're running some kind of business for yourself, you're going to do something that makes money, form an LLC appropriately in consultation with a business attorney. It's totally worth it. And do not commingle your business and personal finances. What does that mean? Well, it means that you go open a business bank account for your business. It ain't that hard. Once you've formed an LLC, you take your articles of formation and you go to a bank and you tell them you want to open a business bank account. It's not hard. Banks treat business customers better than they treat personal customers, even if you don't have much money flowing through there. You will pay some for banking services, but it's cheap. It's real cheap compared to a lot of other things you're going to have to pay for. So just do it. You'll find that you enjoy being a business banking customer of your preferred banking institution. It's a nice way to do your banking. And you'll have a personal account separate from your business account, and you can maintain rigid separation between transactions that are for business and transactions that are not. Now, it's not absolutely legally required that you do this. You don't have to. Some people don't. But if you don't, then down the road, you very well may find yourself in a situation where the legitimacy of your business transactions are being called into question for one reason or another. Someone may be alleging that something that you did for your business was actually not done for your business and that you did it personally. And they may be doing that to try to get a hold on your own personal assets in court, or to defeat the protections that your limited liability business provides to you. And they will dig through your finances and find every instance where you did not adequately separate your business and personal financial lives. And they'll use that as a weapon against you to argue that you should not be entitled to the limitations of liability that you wanted to have and that you should have. and they just might win. And even if they don't win, it's going to be very expensive and difficult for you to defend against that, to the point where it may not even be worth it. So it's definitely worthwhile to just go to the bank, open a business account, carry around separate debit and credit cards, carry around separate checkbooks if you use paper checks, and just maintain that separation. Man, I've got a bunch of business entities. I have separate bank accounts for all of them. Several of them have multiple separate bank accounts used for different aspects of those businesses. And these are not huge businesses. I'm a small-time guy here. I don't have very many employees or anything. My revenue's not huge, but it's totally worth it to have these separate entities and separate your banking, because these formalities matter quite a bit. It is like an insurance policy. It may never end up mattering to you individually. You may go through this for years and think you wasted all your time and effort on it, but you did not. You were just lucky that you didn't have to rely on that separation at some point to defend the legitimacy of your activities. So there you go. That's our business moment for today. Separate your business and personal finances.
Please.
Please. It makes it a lot easier for your attorneys later.
And last but not least, travel. Travel plans for the holidays. No idea what people are going to do. We don't know if people are going to travel for Thanksgiving and Christmas and Hanukkah and everything else that's going on. So let us know.
Yeah.
We're curious.
We know
who's
what we're
going to travel.
We're not traveling.
We'll be here still in our house. Keep us posted. Anyway, next up, financial and goal planning. Today's meat and potato conversation. And with us, we have Rory with Hershenberg Stone-Walsh Insurance Services.
And this is Rory Stone-Walsh of Hershenberg Stone-Walsh.
Hello there.
We're good. How are you?
I'll tell you what I'm doing. I'm going to be staying at home. I'm doing a whole lot of nothing.
There you go.
Perfect.
Likewise.
We'll do nothing together. Isn't that exciting? Or I guess not really together. Separated, but together, in theory.
We'll all just do nothing in our own homes together separately.
Exactly. How fun is that?
So tell us a little bit about yourself and your company.
Well, I am a Leo. And so I'm sure everybody needs to know that. It's very important.
Aquarius here.
Virgo.
Yeah. Hey, see, now we're sharing. Okay. People, what we do is we try to essentially help small businesses. I mean, I love the transition talking about separating business finances and your personal. We have those types of conversations all the time, maybe not necessarily not quite there, but really we help a lot of small businesses set up company health insurance policies, benefit plans. My partner does retirement planning. We do all sorts of that fun stuff. And then we do individual as well. So a lot of people don't have small businesses. So we assist them with individual health insurance policies, life insurance policies, disability policies, Medicare, all the things that we, when you say insurance, that's what we do.
The world of insurance is vast.
It is vast. It is crazy vast. It is. I shouldn't say all the things insurance. We do this. We do the employee benefit side or health insurance side of that sliver of the insurance pie, I should say.
So that's an important point to mention. Insurance these days functions in a lot of different roles. We're talking about it being vast. It's so vast that different aspects of the insurance business serve completely different purposes in terms of what they do for people. You've got one side that I think is typically referred to as property and casualty. And that's what our good friend Irene does, right? And property and casualty insurance is the kind of insurance where you make a claim when something goes wrong and you've lost value or been injured, or someone else has, and they're accusing you of being liable for it. And that's one important role of insurance. But the kind of insurance that you primarily deal with, Rory, is a different role, right? And it's something that supports people, provides services for people that they need routinely. Health, disability benefits, various types of retirement programs that are handled through insurance, and of course, life insurance. All of those sorts of things are, I think, in a different category than the property and casualty policies that many people think of when they think about insurance.
Yeah, no, that's a really good way to put it. From the Irene perspective, you get that insurance and you never, ever, ever want to use it, right? That's the thought process, right? I hope I don't get in a car accident. I hope I don't get sued. I hope my business doesn't light on fire. Those kind of things, right? You never ever want to use that. Now, in health insurance,
it's fire extinguisher insurance.
Yes,
you ought to have them, but you don't want to have to use it.
Right. In ours, there's some of that. Obviously, life insurance and disability. You don't ever get disabled, or hopefully you don't die until you one day do. But you don't want to die prematurely. I guess that's the point. But in our world, we have health insurance is actually purchased for people to use, right? So they use it for everyday things, going to get physicals, going to do their normal routine checkups. God forbid you get sick or you have something major, and obviously in emergency situations, hospitalizations, surgeries, all those fun things that we get to think about. But these policies are meant to be used. And hopefully, I guess you don't use health insurance that much, but you're still supposed to use it a little bit every year. Dental, vision, same thing. You're supposed to use those policies for the betterment, right? So at least you use them for the preventative side. Go get your physical, go get your teeth cleaned, go get your eyes checked. Those things are important so that we make sure that we stay healthy. And ultimately, the goal of insurance companies, part of the Affordable Care Act really was to put these preventative care mechanisms in place, because the thought process is that if you go and get your physical done once a year, then that's going to catch something early, as opposed to, this is definitely a guy thing, but I think this is something that we all do. If it ain't broke, don't fix it, right? That's kind of our motto. So we go around, we walk around, and it's not that bad. I can walk, or whatever. It's just a minor flesh wound. Well, we don't want to go to the doctor. We don't want to go to the hospital. So what essentially happens is eventually those things catch up to you, and then the next thing you know, something big happens as opposed to something preventable in the beginning.
A flesh wound, your arm is off.
Thank you. Yeah. Agreed. People are paying a fortune for health insurance.
Yes.
Right now. You should use it. You should get every ounce of benefit out of that sucker that you can extract.
No doubt. And I think, one of the things that, when we're talking about health insurance now, one of the things that when I sit down with even my wife, she just sent me her open enrollment email, and we just go through the finances and the thought process. I think one thing to think about is there's two trains of thoughts on health insurance. There is the catastrophic angle, and then there's the everyday use angle. And I think the happiest marriage now, especially because of how expensive health insurance is really to find a policy that that you're going to utilize to the most of it, right? So, if you're really, really healthy, even if you have money, there's no point in going and buying the Cadillac plan that you're never going to use, right? And you guys would, I'm sure, be the first people to say, especially when we're talking about planning and financial planning and using your money in the right way. I can't tell you the amount of people that will just say, that has the lowest deductible, I'm going to get it. And I go, well, are you healthy? Do you go to the doctor? And they go, no, I haven't been to the doctor in 4 years. I'm like, well, maybe I should get a higher deductible. Maybe you should think about doing a plan that might have a higher deductible, and save yourself that $50 a paycheck, or, if they have a family, $100, $200 a paycheck, $300 a paycheck, and put that somewhere else. Put that money into disability plans, put that money into life insurance, put that money into retirement. It's much better suited there.
Just don't spend it on insurance you don't need.
Don't spend it on insurance you don't need, right? And I think, so there's the school of overinsured, and then there's the school of underinsured. Mm-hmm. And I think that there's that people too often say, also, that's the cheapest policy, I'm going to get it. And I think, unfortunately, these things are expensive. So I'm never going to sit here and fault anybody for saying, I'm going to get that plan, because look, I get it. It's expensive, and you got to afford what you can afford. But it's also important to think, what? If it's an extra $10 a paycheck for me to go to the next level up, and that next level up might have the doctors and the network that I need to go see, and that's important. Or there's certain types of coverages that I need personally, that might be something that you want to think about, and not just say cheapest, I'm just going to go with that. And I think that's important. I think when we sit down with people, those types of things, I can't stress enough network. Provider networks are so confusing nowadays. Yeah. I don't know if you guys have ever gone on to, the provider websites and gone through the provider search things, there are if you go onto a website and you don't specifically have a button to go onto yours, or you don't go into your specific member portal, there are 50 different provider networks and for all of these insurance carriers. Yeah. So how the heck do you know which one to go to and who to find out? And so,
Choice plus Blue Alpha.
Yeah. And even when you go through your own provider's search process,
it might not be updated.
Be pretty difficult to figure out which boxes to check or which drop downs to pick for your actual plan. I mean, we've done that. I've had to do that for specialists just in the last couple of years, and it can be rather difficult even for somebody who's used to that sort of thing.
No doubt.
It's easy to go through.
I mean, I can't tell you, I do this every day for my job. And even sometimes it takes me a while to navigate some of these websites. And especially, when it's what I find is that doctors, and this is just a tip I'll give everybody, is that always look up a doctor. Don't look up their practice. Yeah. Because a lot of times the doctor will, on these provider searches, will be listed, but maybe not under the practice, or they might have several different locations. And you want to find the doctor. And then from there, you can kind of work your way backwards. But ultimately, find the doctor first and then figure out which practice might be in your network. Because sometimes one practice in Peoria might be in network, but the practice in Scottsdale might not be. It's all, none of it, it all makes sense and none of it makes sense. That's the world of health insurance.
Yeah, and the same doc may be associated with multiple practices, especially in certain specialties. It's very possible that you could end up working with the same doctor through multiple practice groups under different circumstances, and one of them is in your network and others may not be in your network.
Totally.
I think that when people are, deciding on open enrollment right now, it's the end of the year, and it's like, okay, you can't just continue to select the same plan year after year after year because your life changes. So before you start really picking, at what kind of plan do I need? Do I want the lowest deductible? Do I just need critical care insurance? What am I looking for? Think about it. Like, take a moment and spend some time thinking about your health, your family's health. And, is there something that's bugging you that you're thinking that you're going to want to get checked on in the next 12 months? Is your back hurting way more and you can't really stand up straight? Like, maybe this is the year that you go get that checked out. Maybe this is the year you make sure that, if you think you're going to need a surgery, that maybe this year is the year that you go get it. And so that can help really form your financial decisions for health insurance just by taking a moment to stop to look at your health. Like, your kids are going to need orthodontia. Well, this is the year that you freaking get dental insurance. Like, start shopping for dentists that, are in your network and that'll work with you. Like, unfortunately, healthcare these days is no longer a hands-off approach. Like, adulting in 2020 is, navigating literally a minefield. And goal financial planning, part of that is dealing with your health. It's got to be on the checklist because you can lose a fortune in medical collections simply because of poor planning. And
if I can jump in real quick, one of my favorite statistics that I heard about a year ago was the average person takes about an hour to research their cell phone that they buy. Okay. They average about 8 minutes doing their entire benefits enrollment for the year.
Wow.
Yes.
Yeah. So that's what we're up against. And, I think that, yes, it's, but I get it. It's very confusing. A lot of times it's very, very confusing. The language, me and Paul and Paul, by the way, my business partner, Paul Hershenberg, we always joke about how we consider ourselves more translators than actual just whatever we are, whatever our role is. We're translating, basically it's a foreign language to people because all of these terms are just so different and so just not an everyday part of our lifestyle, right?
Absolutely.
And there's so many acronyms.
So many acronyms. Yeah, PPO, HMO, HSA, FSA. And funny enough, if I may jump into the HSA, FSA thought process for a second. So this time of year is a very important time of year. So if anybody out there has gotten an FSA or got enrolled in an FSA, flexible spending account through your employer, this is the time of year where generally you go, oh no, I haven't used I signed up for $1,000 and I've only used 100. Uh-oh. And then with FSAs, there's a clause called the use it or lose it rule. And so basically, if you don't use the money that's in your FSA, you lose it. Now, they did amend some of those rules and laws, and it depends on your employer. Your employer may allow up to $500 to be rolled over, but you would have to figure that out through employers. Not all employers do it. So this is the time of year where people scramble to try to figure out what am I going to use my money on? So one of the things that we always kind of mention is, look, it's November 5th today. Start looking at different ways of utilizing your money. Maybe it's going to get your teeth cleaned. Now that's something you should do as well. Maybe it's going to get your glasses, your new glasses for the year. Make sure you plan out this time of year to make sure you get what you need, and don't waste that money that you spent, because that money ultimately may not ever come back to you. So that's FSA planning. HSA planning is the other side of it. And I don't know about you guys, but I'm a big fan of HSAs, health savings accounts. We really, really do try to stress these, especially for small businesses and small business owners, because it's an easy way of just tax-free money. So with HSA plans, you can sign up for these plans. And generally we recommend either people that are really, really healthy or people that have things going on. HSAs are amazing for those types of people. And the reason why is ultimately, I'll give you my example, and then I'll go into the other side. So knock on wood right now, I don't go to the doctor very often unless I have a major flesh wound, as we talked about. So if I have a major flesh wound, I would consider it. But outside of that, maybe not. So when I go, what I do with my HSA is more of a business strategy. It's more of a financial strategy. I open my account, and every year for individuals, so my family, my wife and my kids are on my wife's company's plan. So because I don't have my family enrolled, I can only do up to $3,550 a year. Every year it adjusts a little bit. So in 2021, it'll be $3,600. So every year I know that I'm going to put that money in either by the end of the year, or the good news is you don't even have to do it in the calendar year. As long as you do it before you file your taxes, you can get your tax break on it. So that is an easy $3,500 tax break I get every year. And the beautiful part is that money's not going away. It's just going into a different bucket. And that bucket ultimately is a bucket where I can either use it on my flesh wound, or if I don't have a flesh wound, I can eventually, and this is the really cool part about HSA accounts, is eventually check with your financial institution that you signed up for. You can actually start investing that money. So I actually had an interesting conversation recently with one of my friends about the reality is that ultimately he was saying, I'm actually now using my HSA as a financial vehicle. And I'm putting in, he's got a family, so he's putting in the full $7,000 and he's just investing it. And he's like, I can't get a better return off of free money. And even though I'm not even using my money for health, I'm just using it. It's better for me to pay money out of my own pocket, because ultimately the money I'm getting from investing is going to be better than if I, even though I get the tax-free dollars of spending it with my account. Now, don't get me wrong, it's still better to put it in the account and use it than not. But you can use it for so many different vehicles. And I guess the point being is that you can use it as an investment tool as well, not just a tax-free vehicle. So HSAs are really, really, really cool. And I think from what we've been seeing that they're really going to start trying to push more opportunities and more strategies for people to get into HSAs and make them a little bit more flexible. Because right now the downside of HSAs, and this is what scares people with HSAs, you don't get copays, right? So people love copays, right? So, and copays are the fixed amounts that you pay when you go see a doctor, or you go to the urgent care, or for a lot of people who go to the emergency room or fill up for medication. That's a fixed, if you pay $10 or $30 or whatever it might be, that's a copay. That's a fixed amount. So people like those because you know that when you go to the doctor, it's a $30 cost. So you just know that. With an HSA, you pay a negotiated rate. So people get scared, and I get it. It's not exactly the most user-friendly method because you really don't know what you're going to pay until you get a bill. So nobody likes that. But all of the other sides of the HSA are really, really, really cool. So from that perspective, so if you're really healthy, it's a tax vehicle or a financial vehicle. If you're really sick, then you have the ability to max out at $7,000, depending if your family's on it, and spend all of that money tax-free to pay for your services. And most HSAs generally are like out-of-pocket maximums are $4,000 or $5,000 or $6,000 or less than a lot of the copay plans that would be next to them at the same cost. So HSAs are really, really neat. I'm a big fan of them, and definitely check them out. It shouldn't be as scary as you think it might be.
Well, I'm terrified, so I'm going to have to talk to you about this further because I didn't know that much cool stuff about HSAs.
So the contributions to the HSA are pre-tax contributions?
Well, it depends on the type of entity. So, and I would actually defer more to you guys on that question. It's more of an accounting question. I've heard that like Inc., corporations can't necessarily if you're the owner, right? I don't know if you can necessarily pre-tax it, but you can still get the tax break when you file your taxes. So there's two different ways to do it. So if you're just an employee, or you're able to through your LLC or whatever it might be, you can pre-tax it through payroll, right?
Mm-hmm.
And then anything you're putting into that account is pre-tax. If you don't do that, and a lot of people don't do it that way, I do it the other way. I just go ahead and just at a certain point, just throw the money in my account, and then I get the tax break when I file my taxes at the end of the year. So you can do it either way. You're still going to get the same amount of tax-free money. It's just which way do you want to do it?
And then if you're using it as an investment vehicle, let's say you've got a family and you're contributing $7,000 a year for a while, but it's been a healthy time for you. So you end up with a whole bunch of money in your HSA and your HSA investments did well. What can you do with that money? Do you have to use it for healthcare, or is there a way that you can use that for retirement planning or something else?
Right. So ultimately, at the end of the day, when you turn 65, it turns into an IRA.
Okay.
Oh, interesting.
So It actually turns into a retirement vehicle.
Pro tip.
This is kind of where my, if Paul was on the line here, I would say he could transition into the retirement vehicle part of that. I don't want to necessarily get myself into that kind of trouble, but I will say that that's what happens if you have an HSA, once you turn 65, it turns into a retirement account. So it is a very, very, very cool vehicle. And I think a lot of the misnomer, or the people think flexible spending and HSA, they get them confused. Flexible spending, use it or lose it. HSA, money rolls over. So if you never use it, you never lose it.
And there's no disadvantage to overfunding your HSA or disadvantage to having your high-performing retirement investments be in the HSA, because eventually you're going to be able to use it the same way you would have used your other retirement funds.
Right. So I guess the only thing if you put money into the HSA that's after your IRS limitation or your contribution amount, you're just not going to get the tax break on it.
Yeah.
But ultimately, yes, to my knowledge, I think you could put money in there and invest in it, even if it's not tax-free. Now, don't quote me on that. There's a lot of nuances on this stuff, but I'm pretty sure you could. But I can't.
So in other words, the 7,000 limit or the 3,600, depending on individual versus family, that's a limit for tax deductible contributions, right. But you may be able to fund more than that. You just aren't able to deduct in that year.
I would defer now. If anybody's actually looking into this strategy, I would for sure. So the first thing is every financial institution has different amounts, you have to hit certain amounts. Now it used to be 10,000 used to be kind of the standard limit where you can start investing it. But I've heard other institutions have gone down to 5,000. I would really say if that's a strategy you're looking into, definitely reach out to your financial institution, find out what you need to do, what limit you need to get up to in order to start investing in. But definitely a great idea.
It depends.
It depends. It really does. Like everything else in healthcare, everything is different for every single person. I would just say, give a call to your financial institution for your HSA and ask them, hey, how do I invest this money? What are my limits, et cetera, et cetera? How much can I put in? Ask those types of questions.
Awesome. All right. Moving on in other financial goal planning topics.
Yeah.
Long term, this has been a crazy year for a lot of people. And it's, a good opportunity to start assessing what your long-term plans are. And there are two real insurance topics that I want to cover, and that's disability insurance and life insurance. So what can you tell people about disability insurance?
Yeah, so I would say that outside of health insurance, disability insurance is probably the most important insurance you can have. Life insurance, I would say those are hand in hand, right? So we'll talk about short-term disability and then we'll transition to long-term disability. Now, I'm of the mind that, the goal would always be for me to set aside a few months, hopefully, of at least finances so that if God forbid something happened, I have them in my bank account, right? But ultimately, I know that these are tough times, and these are not easy times right now for a lot of people with what's going on. So a short-term disability policy, what that essentially can do for you is if God forbid you get sick or you get hurt and you can't work, there's a set waiting period that you have to be out for, a elimination period. It can be anywhere from as short as 7 days. Most of the time, it's about 7 to 14 days. It can be longer sometimes. Sometimes it can be shorter. But ultimately, generally, it's about 7 to 14. But once you get through that, short-term disability policies pay you generally up to about 60. I think legally it can be more than 66% of your paycheck to you, and up for a determined amount of time. So anywhere from generally it's 3 months up to 6 months, depending on the policy. And so when you're planning, a lot of times the short-term disability for me, I really, really want to talk to people that have either pre-existing conditions and can get it through their work. B, especially young women that are family planning, right? That is a huge deal because you can sign up for a short-term disability policy and it can pay for you to be out of work while you're on maternity leave. So that's a big deal, right? So from a maternity perspective for young women, that's short-term disability. Now, I would say ultimately outside of, again, health insurance and then life insurance right there too, long-term disability is probably the most important insurance you can have. And the reason I say that is ultimately, again, these are things we don't want to think about, right? Long-term disability is one of those things where, God forbid, if that actually did happen to you, the reality is long-term disability, if you don't go back to work within a year, the statistic I think is like 80% that you're just never going to go back to work, ever. So the reality is if you find yourself in that situation, long-term disability, if you get it, depending on where you get it, you can get it through yourself, as an individual, where you cover yourself, or you get it through your company. But overall, most of the time, that will pay you until you reach Social Security disability retirement. So, I mean, it's amazing. I've talked to people that have been on disability and have called me and said, literally, this is saving my life. Like I'd be homeless. Like I would. And I don't know where I would be if I didn't have my long-term disability policy. It's one of those things where we've talked about earlier, figuring out the right threshold for health insurance, not over-insuring yourself. Because if you have the opportunity to maybe buy down a little bit on your health insurance, but pick up that long-term disability policy that's sitting there offered to you, that is a very, very good idea. I would highly recommend that to everybody that can do it.
I also think that from an employer benefits standpoint, it is the best way to protect your employees is to just cover short-term and long-term disability for your team because Absolutely. It is so freaking cheap. Just do it.
But I think you bring up a good point too. So I think number one, we all know that benefits ain't cheap, right? And especially as an employer, we know that it's an expense. So if nothing else, if you look at it, and by the way, like us brokers, we do that. We quote it. We can quote it out for you. We can bring you quotes, show you what the cost would be, see if it makes sense, right? So if it makes sense, as Rochelle said, it's shockingly inexpensive. But if it's something that you overall look at and say, it just doesn't make sense in the budget, you can offer voluntary programs, right? So we've all heard of those, the Duck, Aflac, or Colonial, or there's a million different supplemental companies now, where you can offer these types of programs to your employees and you don't pay a dime, but you're giving your employees the opportunity to get that policy so that they can protect themselves. And a lot of times, employees or somebody that's an individual, it's harder to get a disability policy on your own because of underwriting and other things than it is to get through a company. So I would definitely say that if nothing else, if you can't afford it or you can't make it part of your benefit package, at least bring in the other side where it's no cost to you outside of just paying a bill, but all you're doing is just allowing your employees to pay for it and you deduct it out of their paycheck. And I think that's a really important part of the benefits package that employers can put together.
It's certainly something that I was interested to find out about when I first became a business owner and started getting the sales pitches directed at me from Aflac agents and other insurance agents and people such as yourself start courting you a little bit. I had no idea what it looked like from the employer side, dealing with these sorts of benefits. Everyone's used to it being an employee and being told what your company offers you, what your options are. And it's different everywhere. And some places have good things. Some places don't have good things. Some places have one option only. Other places have a huge menu of things and don't explain any of it. I got to experience a number of those working for large companies as a standard employee and never really understood what it was like on the other side of that. Where does this stuff come from? Why does my employer offer this rather than something else? Why does it suck here at this company instead of being great like it was at the other place? And the end result is, it depends on how much attention your employer is paying to this. Frankly, if they give a shit, they can give you a pretty good plan with very little additional cost on their part. It's just a matter of hooking up with the right agents at the right institutions to offer things that are useful to the employees. And I was very surprised to learn how inexpensive the disability insurance, both short-term and long-term, and the various supplemental offerings are. It's dirt cheap to the employer. And it's dirt cheap to the employee if it's a supplemental option that's paid for by the employee. It hardly makes sense not to do it. With that said, with very small companies with a small number of employees, the administrative overhead can be a little bit too much to justify it. But if you've got, say, 6 or 8 employees or more, anything above that number, it's totally worth it to offer a good menu of really solid options for people because, like you said, Rory, it's much harder to do it as an individual. If you're trying to get these coverages without going through your employer, sometimes you just can't do it. And other times you're going to pay a whole lot more for a much more limited menu of options.
Yep. Yeah. No doubt.
And you're looking through your open enrollment options, just go ahead and click that box for short-term and long-term disability. Yeah. It's worth the whatever you're paying for it.
And I would actually go to the next part on that too. Is we've talked about deductible isn't always everything, right? And we just talked about HSAs and things like that, where an HSA there's so many cool things. You get a high deductible, which might sound daunting, but a lot of times you can get these high deductible plans. Now, HSAs are a little different. A lot of times, but most companies, HSAs have rules where you're not allowed to get you can't have an FSA and an HSA together, or you can't have things that are supposed to pay for your deductible, quote unquote, but you can actually get HSA qualified supplemental plans. You just have to talk to your agents about that. They can do it. And essentially, if you pair those types of things up, you now just supplemented, God forbid, your $5,000 or $6,000 deductible. And that's where I say you buy down a little bit, go grab yourself a critical illness plan or an accident plan or a cancer plan or whatever it might be. And those are Mike said, they're not expensive. They're a few bucks. And then ultimately, now you just basically paid for yourself a little gap insurance.
Yep.
So God forbid it happens, this just paid for it. And now you didn't pay that much for your health insurance and you paid a little bit for this. And now your deductible's paid for. So yeah, there's just all these little types of nuances that you can do. And, it is daunting. And I know that's the last thing people want to do around the holidays, but it's super important, right? It's things that can shape your financial futures, right?
It's going to require spending more than 8 minutes.
Yeah. Yes. It's going to take half an hour. You got to think this through. It's going to take half an hour.
I was going to say it's going to take an afternoon. It's a project, but it's worth it.
Well,
it takes an afternoon to go to one doctor appointment. So,
right. But it should, right? It should take you should plan out a half hour to an hour, at least, right? Just to review it, to figure out what questions do I have? Do I understand what I'm looking at?
Yeah.
All these things. Yeah. And transitioning that into life insurance, overall, life insurance, obviously, I feel like, from the benefit perspective, most people kind of get insurance. I think people understand everybody's going to die, right? At some point, everybody is going to pass away. And the reality is, how well do you have to plan this out? Because, people die and they know that they're going to die, but a lot of people don't know that they're going to die. And then unfortunately, they leave their families in really, really bad shape. I had somebody call me the other day asking if their health insurance policy, their brother just passed away. It was a horrible story. If their health insurance policy paid for the funeral. And I said, oh, I'm so sorry that's not how health insurance works. And the reality is that those are the types of things, as silly as it sounds, even just to bury yourself is expensive.
20 grand.
20 grand, right? That's exactly, 20 to 30 grand is just a simple burial with a casket and whatever else. But that's money. And you don't want to put that. The reality is, even if you get yourself a $20,000 or $25,000 life insurance policy, that at least doesn't put your family in debt just to put you in the ground. And as morbid as that sounds, that's reality. That is reality of where we are as a society, is that we all are trying to hopefully help our families and keep our families in good shape. And as simple as a $25,000 life insurance policy will at least keep your family out of debt for you passing away. And then from there, then you look at the next step, right? And that's, okay, what type of debt do we have? Mortgages, cars, what debt do we accrue? And unfortunately, most of us have some debt we have, right? Unfortunately, and I know you two deal with that a lot. And the reality is that you don't want to leave your loved ones in a bad place. And life insurance can help alleviate some of that stress of, if God forbid you passed away, how's the house going to get paid off? How's the car going to get paid off? Also, depending on your strategy for your kids, do you want to put away money for your kids' college tuitions? Though that's what you have to think about for life insurance. Do you have a permanent need for life insurance? So, unfortunately, people have children that have things that they're born with that they may not ever be able to function on their own and they may have permanent needs, right? So there are all sorts of reasons why life insurance are very, very important. And for the most part, term life insurance. And what that means is when you buy it for a set amount of time, 10 years, 20 years, 30 years, and then you put a finite amount on it. Let's just say 500,000, 250,000, whatever it might be. They are pretty cheap. It's remarkable how cheap especially the younger you are, the cheaper it is. So if you buy yourself a 30-year term policy when you're younger and you're just getting married and you're having kids and you're 30 years old, that 30-year term policy will probably be $20, $25, $30, like something that you can manage and not think about on a monthly basis, that you now know that, hey, I'm protecting my family in the future if, God forbid, something bad happened to me.
Absolutely.
Yeah.
That's very important. These are things that people tend to not want to think about.
No.
And everyone believes in the abstract that these are things that can happen. But as you mentioned, everyone dies. It's not something that's abstract. It's a guarantee, in fact, that you will at some point have to deal with that for yourself and your family members. And so financial planning needs to take into account the inevitable endpoint of your financial plan. And there are a lot of different ways of dealing with that, and it is specific to everyone's own financial situation. But usually life insurance is going to be an important part of that plan. It's usually an appropriate solution because paying off the debts, dealing with the burial expenses, all of those things are important. And even if you have a substantial estate, even if your net worth is very positive and your family is going to be well provided for, it may still be a good idea and a worthwhile investment to use life insurance to supplement that. It's something that you got to look at, and it is something you have to evaluate in terms of the probabilities of an earlier death from any particular issues that you can reasonably suspect, the cost of term policies, the cost of whole life policies, all of these different approaches. You got to run some numbers or work with someone like Rory to help run numbers and figure out what your options are to make sure that you're not causing further financial stress in the end of your life and shortly thereafter for your family.
So your 2020 goal planning tip here is, if life insurance, if you don't have any, this is probably a good year to go ahead and get some.
Oh my goodness.
Even
I
if
think
you're doing a $25,000 policy, term policy, you can afford it even now.
Yes.
we have this thing called a pandemic going on. I don't know if anybody's heard about it. There's this thing called pandemic happening. And if this is not a time when you can think about that point, then who knows when you're going to think about it. But yeah, it's important. A couple other side notes on life insurance. When you're younger and you're family planning and you're starting your family, that might be a time when you go a little heavier on your benefit. because you've got kids, and your reality is you're going to have those kids in your household for at least usually 18 years. And then you can kind of, we say 20-year terms are good. You kind of get to that 20-year term point, and then maybe you dial back the life insurance at that point. So that's a thought. Other thought is beneficiary. This is like the worst case scenario, but make sure you always review your beneficiaries.
Annually?
Annually, yes, because things happen. People get married, people get divorced. And we've seen some nightmare scenarios where the death benefit for a gentleman that was one of our clients didn't update his beneficiary form and got remarried, had kids, and passed away. That money went to his ex-wife, and that money did not go to helping his family with his children that he intended to have it there for. So
very important to check those things. Unlike wills in Arizona, which are presumptively revoked if they're in favor of a spouse who you've since divorced, that is not the case for designated beneficiaries under contractual arrangements. So beneficiaries of accounts that are payable on death, if you have investment accounts with beneficiaries designated and you get divorced, your ex will get that money if you didn't update it. And the same with life insurance policies and other types of contractual arrangements. Your assets in your estate may not go to them if you failed to update your will. Instead, they'll go to the statutory defaults, and maybe you don't like that either.
Yep.
So these things are very important to keep updated on a continuous basis.
So on your goal planning checklist, you should have a little box that says check beneficiaries.
Yep.
It'll only take you a couple of minutes, but it's well worth the effort of making sure that, you're updating that correctly, because things change. People die, relationship dynamics change. Sometimes it's time to have a backup. You've really got to, unfortunately, put that on your adulting to-do list.
Yep. It always has been part of adulting. There may not have been as many options available to plan for your retirement and your death in the past, but this is something that all humans have always had to deal with, going back to ancient times.
Yep.
It's certainly not new, and it is just a difficult part of life to make these plans and to do the best to provide for yourself through the end of your life and to provide for your family afterwards. It's part of being a human. It's got to do it.
Called being considerate.
Yes.
This is great.
Speaking of being considerate, there's one thing we want to talk about with retirement planning. And that is yes, you have to have, look at your 401k, look at your IRA, make those contributions, make sure that, you're looking at your real estate investments and all of that's part of it, and your cash on hand. But this is directed at individuals in our last 5 minutes who are looking at retirement and want to buy a business.
Oh, yeah. Or I want to split this into two things, and we'll cover it quickly because we're running out of time. But people who own businesses and want to retire and get out of it, and people who want to retire from a job and get a business. Now, you might think that if you just bring these two people together, the business owner can sell their business to the retiree who wants to have it, and everybody's happy. Well, the problem is nobody's going to be happy. Lots of people have had a dream for years of owning a small business, usually some kind of a store or a tourist business in a tourist destination, or maybe a bar or restaurant. And so they've saved up and they think they've got enough. They've got maybe $500,000 in retirement accounts, and they've got their eye on this local restaurant they want to buy when they retire. Oh boy, are you in for it? I represent the owners of those kinds of businesses. It's not retirement. It's a whole other job, and it's a bigger job than what you've got. Whatever you've got in your head about what it's like to be a small local business owner, if you haven't done it before, the experience is completely different than what you're expecting. Doesn't mean it's a bad idea necessarily, but if that's your plan, you need to direct your career towards that. You need to gain experience managing businesses, managing employees, running the exact type of business that you're planning on having in retirement. Plan it out in the very long run and make sure that you're picking the right options and that you are absolutely poised to make it work. I certainly know people who have made that work. I've met them. We met a wonderful retired couple in Hawaii on our honeymoon who owned a local ice cream shop in the upper Midwest, and they were doing great with it. They bought it after they retired from their corporate jobs. Well, you know what? They both had tremendous business management experience. They spent their careers managing much bigger operations than that. So it was a piece of cake for them to get a general manager in place so they can travel the world and make their dreams come true with the profits from their ice cream shop. Good deal. But boy, did it take them a lot of planning, decades of planning. They directed their careers towards it. Now, on the flip side, let's say you are a business owner and you want to sell in order to retire. This is also something you need to plan for long in advance.
5 years.
At least, if not from the very beginning of your business operation. If you have an exit strategy which involves sale, that is your goal. Your product is not whatever your business sells. Your product is the business itself. In the long run, that's the thing you actually want to sell, not whatever it is that you do on a day-to-day basis in that business. And so your overall level of operation needs to be higher. Your approach needs to be directed the whole time at creating a solid record of financial success that looks good on paper to maximize the valuation of that business, about putting systems and key staff in place to make a transition easy. All of these kinds of factors are critically important, and that's very different than your approach if you intend to pass it on to the next generation, or if you intend to continue owning it in your retirement but not be involved day to day. All of these things require different strategies that have to be executed for years in advance in order to achieve good results. So whatever your plan is, whether you want to become a business owner in retirement or whether you want to exit being a business owner in retirement, either way, this is your career strategy and it's not something you do at the last minute. So plan it very carefully. Make sure all the ducks are in a row. Work with professionals like myself and Rochelle. Work with other professionals like Rory Stone-Walsh and Paul Hershenberg to make sure that your arrangements are fully optimized as early as possible to get the result you're looking for. This is long-term planning.
Yeah, you have to have a checklist. You need to know where you're going in life because life goes fast and we only get one. You got to plan it out. Any last pro tips, Rory, before we wrap this up?
Wow, man, I think I've exhausted myself on this one, and you guys did a good job. I'm just deeply thinking about what you guys just said. I'm like way in my own head now. I'm good. I just appreciate you. Thank you guys for having me on. It was really a pleasure to get to spend some time and go through this stuff today.
Well, it's good to see you. It's been a while.
Thank you.
I know.
Yeah. We were talking before the show started here about when the last time it was that we got together, and it was at a birthday party
for Cheryl
in February, right?
Love you, Cheryl.
Yep.
Yeah.
At Hula's.
Before the COVID hit, so that was it.
Yeah. Yeah, it was the last time we went, really kind of hung out with a bunch of people, and of course my friend Annie's bridal shower. But I mean, anyway, Rory, tell everyone how they can reach you.
Yeah.
Well, yeah, absolutely. We are. You can reach us. You can reach my firm. We're in Tempe. My website is www.hsinsuranceservices.com. My name is Rory Stone-Walsh. You can reach me at 602-614-5344. If you have any questions, we're here for you. We're here to help you, assist you through these types of the crazy world we live in nowadays, and help your employees out with their benefit needs.
Awesome.
Excellent.
In today's recap, here we are. Remember, you need a plan to reach your goals. So you need retirement, a great insurance broker like our guest, and know your health insurance options. Make that checklist. Spend more than 8 minutes this year on your benefits for 2021.
Put more time and effort into your health insurance than your selection of a cell phone.
Please. And thank you to our sponsor, X-Firm, helping people with financial transaction planning. You can find them online at xfirmlaw.com, or you can call 480-305-0603. And I'm your co-host, Rochelle Poulton with X-Firm. And you can reach me at the information I already gave you.
And I'm Mike Poulton with the law firm Poulton & Royan. We do business law and litigation here in Central Phoenix. You can find us online at www.pnlaw.pro, or give us a call at 602-427-5613. That's been Lawgitimate. Thank you all for listening today.